5 Key Facts about the Federal Reserve. The Federal Reserve was created in 1913 with the signing of the Federal Reserve Act after a series of banking panics which caused widespread bank failures and economic turmoil that exposed the vulnerability of the U.S. financial system. The Fed aims to control inflation, foster a healthy level of employment, and maintain a stable financial system by adjusting the money supply and regulating the banking system, striking the right balance for sustainable growth. The Fed operates as a semi-private entity that consists of 3 key components: the Board of Governors, the Federal Reserve Banks, and advisory councils. The Board of Governors is made up of 7 members appointed by the President and confirmed by the Senate, who oversee the Fed's activities and help set policy direction. There are also 12 regional Federal Reserve Banks across the U.S., which serve as operational arms of the central bank, representing a different district working to support local banking systems. Finally, there are advisory councils that provide insights into economic conditions and help guide Fed decisions. There are several tools the Federal Reserve uses to manage the economy. One of the most important is the federal funds rate. If the economy is overheating and inflation is rising too quickly, the Fed might raise the federal funds rate, which makes borrowing more expensive and slows down economic activity. On the flip side, when the economy is sluggish, the Fed can lower the rate to stimulate borrowing and investment. Another tool the Fed uses is open market operations, which refers to the buying and selling of government securities, like Treasury bonds, which increases the money supply. Conversely, if the economy is too hot, the Fed might sell bonds to take money out of circulation and reduce inflationary pressures. Lastly, there's the discount rate, which is the interest rate the Federal Reserve charges to commercial banks for short-term loans, another way to control liquidity in the financial system. Federal Reserve decisions affect nearly every aspect of our lives. For example, when the Fed raises interest rates, the cost of borrowing increases. This means higher mortgage rates for homeowners, more expensive car loans, and higher credit card rates for consumers. Businesses might also face higher costs for financing. On the other hand, when the Fed lowers interest rates, it's easier to borrow money, which can stimulate economic growth, boost consumer spending, and help businesses expand. The Fed also helps ensure that our banks are operating safely and soundly, which builds confidence in the financial system and promotes stability. During times of crisis, the 2008 financial meltdown or the COVID-19 pandemic, the Federal Reserve acted quickly to provide emergency funding to the economy and keep the financial system running smoothly. If you liked this video, like and subscribe. Thanks for watching.